Good morning and welcome to your macro outlook. It is Monday, April 14th, 2025. I'm Patrick Ceresna. All right, let's start off with the economic news. This week, we have a couple central banks coming out, the Bank of Canada and the ECB coming out with monetary policy statements. We also have Fed Chair Powell speaking on Wednesday at the Chicago Economic Forum as well. On Wednesday, we also have the core retail sales, probably the only real data point that comes out that will be of genuine importance. Obviously, retail sales reflecting whether or not the consumer is generally slowing and whether we could potentially be moving toward a recession. So that, at least for this week, is going to be the focal point. So let's look at it this morning. S&P 500 futures up 70 S&P points at the time that we're recording this, continues to strengthen a little bit off of those lows. Obviously, what continues to be considerably in the headlines is the tariffs. But I have a very specific position on this now. The tariffs certainly were responsible for the market volatility that we saw that caused the downspill. But more or less, the tariffs have now been fully baked in the cake. And more importantly, the existing administration is slowly trying to calm the markets down and walk it back to make sure that they don't cause any further panic. Now, while it continues to be headline after headline, my position is that the market will no longer be surprised by this. Now, that it has been within my thesis that the stock market low for this last swing is already in. So when we look at this chart, and we see that S&P 500 printed down just below 5,000 temporarily on that. That, I think, is going to be a low that will hold not only for the next few weeks, but arguably may even hold for the next few months. Now, that doesn't mean that this is all over and that there isn't more downside, but I think there's a much greater diminished chance that tariffs will not be the trigger to make another downturn. More importantly, then what will be the next trigger? And that has to be all around recession risks. And so I want to quickly, first of all, start off by just showing the poly markets probability of recession, now sitting around 53%. But the last 2 weeks, we've been sitting as high as 65% chance of an economic recession. This is something that is certainly a risk as we move forward. Also, I want to just go back and review what Besant said on Meet the Press on NBC. I showed this to members weeks, if not a month ago. I'm trying to remember exactly when it happened, but this is just a re-review of something that was already talked about. But I think it's important to reiterate a couple of the key things he said. He goes, he's not worried about the recent market downturn, but added that there are no guarantees that there won't be a U.S. recession. In other words, they all along knew that when you do Doge, tighten fiscal spending, create business uncertainty associated with tariffs, that there's going to be a knock-on effect. This was something accepted. So when we're talking about the risks going into the summer and the chance that this turns into a bear market, almost all bear markets are associated with recessions and corporate earnings contraction. And so the puzzle to solve as to whether or not there's another shoe to drop later in the markets in the months to come is whether or not recession risks continue to increase. This chart right over here shows that markets start to sell off about 3 months before recession. But what the worst part of the drawdowns tend to always be seen after the recession has already been confirmed. And so we're in a situation where we're starting to see the situation deteriorate. But the real question and the puzzle to solve is that recession confirmed? Is there going to be corporate earnings contraction? Is there multiple contraction? All of these different things that could see the S&P considerably lower going into the summer. And I just want to highlight the last kind of statements that from his interview that I think are worth always mentioning. He goes, I've been in the investment business for 35 years, and I can tell you that corrections are healthy and normal. What's not healthy is straight up. That you get these euphoric markets. That's how you get a financial crisis. It would have been much healthier if someone put the brakes on in 2006, 2007, and we wouldn't have had the problems of obviously the great financial crisis of 2008. So I'm not worried about the markets. Besant goes on to say, goes, over the long term, if we put in good tax policy in place, deregulation, energy security, then the markets will do great. And I think that that's a very important thing to just highlight is that the administration continues to be focused on the bigger picture, and they understand that there could be a short-term pain to attain what they're trying to achieve. And I think that fits very well with the frame as to what if we're going to get another sell-off, it is likely not going to be driven by tariffs, but rather a deterioration in the circumstances that has created this negative feedback loop that is spurring the economy to slow into this recessionary state. And if that happens, the markets are going to go lower. Okay, so let's talk technicals. First of all, we have a volatility index that's sitting around 33, which is on a daily implied range is 113 S&P points for a one standard deviation move. So we still have to expect these 100+ point swings day in and day out on the markets. That we're simply at a higher elevated level of volatility. Now, when we called the market bottom back last Monday, and we've been long the market since, our upside target has actually been this 55 to 56.50. So the issue we now have is that while we got the bottom right, the thing is that do you go and buy? Well, to be honest, the asymmetry is incredibly neutral here. In other words, on the very short term, the upside then the bulls are bouncing the market. The upside is the path of the short-term trend, but I only see limited upside potential. I don't think we're going back to 6,000 on the upside of the S&P. And so when we're up near 5,500, could we clip a couple of hundred extra S&P points over the next week or so? Absolutely. But we have a shortened holiday week this week. Easter Friday is coming. Is a market closure, and so a lot of people will be potentially taking time off over the weekend. So if we get a bit of a market rally early this week, we could see the whole market just settle down and take the weekend off, and we find ourselves in early or late April suddenly, and the market is at overhead resistance and could start showing volatility to the downside as going into May. Anyway, point is, I'm not rushing to buy markets. In fact, if we got another 100 or 200 S&P points, I'm going to be doing a little bit of profit taking on a lot of the long positioning that we have already taken on the upside. So let's move on. I want to just touch on one other equity market in the Russell. And you can observe here the Russell 2000, the bounce has been far weaker. There was obviously this reflexivity in the S&P 500 driven by all sorts of factors and flows, but the Russell didn't get any of that. And that to me only supports the thesis that this is likely still a bear market rally, and that likely going lower later in the second quarter. Now, this rally it could make it all the way to 2,000 on the upside on the Russell, but I wouldn't be looking for much more than that. A quick little zigzag of this back to that 50-day moving average, right to, let's say, a 50% retracement area where the 2,000 level lies would be very logical upside targets. And so, can you clip a 5% rise in the Russell over a couple of weeks, which is the path of least resistance? You can, but I would just have one foot out the exit door and don't be buying long-term buy and hold positioning in the market is the best way to summarize it. And you can observe that that's echoed in almost all global equity markets. Let's start with the Nikkei. The Nikkei had that devastating drop in Japan, very reminiscent of its July-August drop when the yen carry trade was unwound. The So we're getting a reactionary bounce, and just observing, at least up until now, notice that after the yen carry trade bounce, the velocity of the rise was very, very rapid. At least here on Monday morning, we're not seeing the same gusto to undo such a heavy sell cycle. If we find ourselves below this 35, 36,000 level at the same time as almost all global equities are kind of peaking and rolling, then that will just confirm that this is a bigger global deleveraging in the markets, and it's going to take more than a week. But, maybe we'll have more information when I do another video next Monday. But right now, it's the same story. Same with Euro stock. Look at the devastating 20% drop in a week. It's bouncing, but it's not an impressive bounce. Overall, I would kind of put them all in the same category, which is that we have a very vicious sell-off that ended. We're having the mean reverting bounces occurring. Those can last the entire week into next week, and the asymmetry is diminishing every point that it goes higher, because this bigger sell-off is likely not over. It's just probably over for the short term. So let's move on to some of the other assets. Starting off here, I want to touch on the dollar index. This is where we continue to see some very heavy selling, but the measured moves are done, which is that the downside move has entered what we define as a profit-taking zone on the downside. So it's oversold enough that a reactionary bounce is typical. So should one buy it? Well, if you're a short-term swing trader, yes, you could definitely speculate in the Forex markets on a reaction that the euro, let's say, heads back to 113 or 112 or something like that on a reaction. But I don't think that this is a longer term buying opportunity on the dollar. It's just going to be an oversold bounce that is going to let it settle in, and things will just calm down a little bit for a few weeks from this very high, intense decline that's put a lot of stress on a lot of traders out there. And nonetheless, the dollar here creating a reaction. Again, now on the euro, that would be a retracement back to 112, 111 on the downside. On the pound sterling, that would be coming back to the 129 level near the 50-day moving average. And on that US dollar yen, it would likely find its short-term lows here in the 140, 142, and we could easily see a bounce back toward 146. One thing I'll say is this: the dollar downtrend is still the dominant trend, and in the bigger picture is probably the path of least resistance, in a sense that the dollar probably is going to go lower into the summer. It's just simply there is no asymmetry or any tactical benefit in starting to chase this trade with brand new US dollar shorts when this thing is going to squeeze you the other way on some reactionary bounce. We're going to call some good entries on this as we move forward. The Bitcoin getting a bounce. It's been a far more quiet period in the crypto space relative to the volatility that we've seen in almost all other assets. One of my whole arguments on Bitcoin continues to be that with it having been securitized with derivatives and ETFs and all sorts of other things, it's become a risk asset. And right now, when the whole market is under pressure, it's hard for it to get any flows. Now we're getting it held up much better than equity markets. It's bouncing here. Could we see it work its way to 90,000 on the short term? Yeah, maybe, because we're not bearish for another breakdown yet. So it's interesting though. Trading exactly at its 50-day moving average, which at least for the last 2 months has rejected it perfectly over and over again. So I think it would be quite the accomplishment for the Bitcoin traders to be able to clear that hurdle and get a little bit of a burst higher. Let's move on to precious metals. Now, gold happens to be the single strongest bullish price action out there. That 3-day burst higher was extraordinary. Now, we had a very short-term target up into this 3,300, but I was not expecting us to be in this profit-taking zone this quickly. This is an acceleration of slope. And while we have some short-term overhead resistance on gold, this is a space where we have to be careful because this could go parabolic. And if it does, then the bigger measured move on this thing is all the way up towards 3,600 on the upside. And so we're going to be watching closely as to whether or not this becomes a level of short-term resistance, or whether this thing can burst higher. One way or another, we're not short gold. This is a primary bull market. And we're just discovering along this level as to whether it reaches short-term resistance. We're still far more interested in buying dips, and this is the wrong time to be chasing that. Crude oil. Crude oil looks exactly like all other risk assets. It had a vicious drop, finished its symmetrical measure move, even overshot it on the downside temporarily, and now we're reacting. Now we're going to see crude oil probably trade as high as $65, $66, but in technical analysis, we have the rule where what was previous overhead resistance, or sorry, support becomes overhead resistance. The likelihood that crude oil beats 65, 66 upside would take a big macro catalyst, maybe an escalation with Iran or some other kind of major disruption that could occur. But if it's just technically trading without catalysts like that, expecting it to stay below $65, $66 should be the starting base case for almost all traders at this stage. Very quickly, just copper getting the same reactionary bounce. We're going to get to the, we were targeting this 450 to 475. I don't really want to have a much higher upside target. So this is a period where you got to just temporarily leave it alone. Uranium was incredibly oversold, got a bounce, at least on the equities. The uranium itself didn't really move that much. It's been quiet here, and I don't want to make a big, bold call on it. But let's wrap up with just a quick look at the interest rate market. And I want to start with short-term rates. First of all, let's go to the SOFR futures market. During the vicious sell-off, we got up to the 97 level, implying about a 3% interest level by the end of the year, as everyone started pricing in recessionary Fed cuts. The FOMC meeting minutes threw a cold bucket of water on that, as Powell seems to not be tilting dovishly in his tone, which caused this to give back over 50 basis points in a short window of time. I still think that this is a great trade. I feel that Powell ultimately will have to be forced to pivot. I think that the inflation is not going to be remotely as sticky and high as he's worried about. Almost all commodity prices are getting slammed. Now there is going to be short-term impact by tariffs, but you have to focus on longer inflation expectations, not just the short-term transitory ones. And when some form of recessionary tone starts to be embedded in there, Powell is going to have to become more dovish, and the market has not fully pricing that in. I still think that this is a place to be in a trade on the upside. Now, what it was under a substantial stress was the long bond. In particular, I'm going to focus on with a chart of the TLT, which saw that huge unwind during the basis trade, and that ravaged the market. It's come down to a support line. This is some serious technical damage. And while a double bottom could form and a bounce back to the 50-day moving average can be expected, where we see an 88 or 89 this week while we're trading, I'm concerned about having too strong of a bullish stance. I was positioned quite bullishly a couple weeks ago, but this reversal basically throws a bucket of cold water on it, and I think at minimum positioning in a neutral stance is incredibly important. And finally, I wanted to talk about the canary in the coal mine, which is the junk bond markets and high yielding markets, and they got ravaged, and they're not bouncing. Credit spreads continue to be wide. This is always something present during bigger, deeper market corrections, and continues to be, in my opinion, a big issue about what is in store going into the summer. That's where we'll wrap it up for today's macro outlook. I'm Patrick Ceresna. Those of you listening to complimentary version can get these every single day at Big Picture Trading. We have a free trial for anyone to try out. Just visit our bigpicturetrading.com website. Thanks, everyone.